I asked Jerry Wattenberg, Managing Director at the financial consultancy JTW International, if this really is all about China.
Well, really, I think, you saw today that, China had really grown so fast, so quickly, and the stock market had been at all-time highs. So a correction was really due. And, the market really needed any little type of information to trigger it. And so what you saw is a really dramatic sell-off in China, but not so much, for example, in Japan. So when it kind of, it started over in Asia, caught up a little bit in Europe, where it took the news pretty hard, and the U.S. is now trying to digest whether this is an ongoing problem or something to look at or just a short-term market blip.
Okay, so this was a correction in China, and clearly that has a lot to do with the fact that the market there has doubled in value, so coming back by 8 or 9% isn't going to hurt investors that much. They can't really complain, can they?
That's the exact way to think about it.
But coming back to why are we losing ground so sharply in Europe? 3.6% were the losses on the Zurich SMI, for example.
I think this is the first real market correction you've seen out of Asia, and everybody thinks that China is, the be-all, end-all, and the driver of global growth. So any concern out of that growth stopping will knock on first thinking to Europe and then secondarily to the U.S. However, it's interesting because European growth has actually been stronger than the U.S. So the stock markets, when they kind of recoil, I think will probably strive a little bit further ahead.
Well, you can explain why there's been weakness in commodity stocks recently, because again, commodities have been driven by Chinese growth. But once you take those commodity stocks out of the way, you're still looking at much larger losses. So to that extent, it's an overreaction, isn't it?
That's a good way to think about it. I think, once you get an initial market correction, people then start to panic and start to think, well, maybe there's a little bit more behind the scenes that we don't know about, and maybe it's down 8% today, maybe 5% tomorrow. But I think if you take a step back and, as you said, look at it on the longer-term perspective and see that the stock market has doubled, this is not a large correction.
Let's come to the U.S. market. I mean, clearly, as this wave travels west, it seems to lose its intensity. So we're seeing lower losses, really, slighter losses in Europe than we are in China, and in fact, slighter losses on Wall Street. Why is that? Well,
I think, you got mixed data out of the U.S. today, and once you had durable good numbers, which were lower, but yet consumer confidence was higher. So the mixed data out of the U.S., I think, kind of caused investors to maybe it's not a systemic problem, maybe just a market anomaly out there.
So this is kind of a big knee-jerk. It's not a major global market correction.
Well, one of the things you have to think about is that individually the markets around the world have been less volatile over the past year. However, we've been seeing a significant amount of relationships and inter-volatility between the markets increasing. So you would see something like this happen would trigger increases in volatility across the markets. However, if you look at independently, actually the volatility in the individual markets has actually been a little bit lower over the past year.
How low do you think, briefly, these markets are going to go? For instance, look at Wall Street.
It's a tough call. It's a matter of, we've got more data out of Europe and the U.S. this week. And next week, we've got the unemployment numbers out of the U.S. as well. So I think the market will want to see more fundamental issues before they make a long-term decision whether or not to sell and go to bonds and cash.